So good morning, everyone. It is 5:30 in the morning, and what I want to do is just do a review for you on Chapter 4 slides here, and of course I'll see you tonight. So this covered financial statements, and as we talked about, a lot of this you may have seen if you were in Business 330. Right, income and balance sheet, income statements, cash flow statements, and the big thing here was the survival or break-even revenue to keep your business going. There was a couple of equations there, so just wanted to make that we'll give that some emphasis. So we discussed GAAP, General Accepted Accounting Principles, and FASB, the Financial Accounting Standards Board, is the organization that puts out these principles. And if you take accounting, or if you're going to take accounting, you'll see more of that. Okay, so accrual accounting, as I said, simply when you sell something, even though you haven't received the cash, it goes on the ledger as a sale. Right, but you didn't realize it yet, right? You recognize, I sold the car, or the dealer sold the car, but when you're gonna come here with the check, So so it's that kind of thing. All right, so if you had 330, you've seen depreciation, right? You write or reduce the value of something over time as it ages. So as I kind of said, you could reduce the value of your car or something like that, if you have a business as it ages. So anyway, and over time you'll see the accumulated depreciation on a balance sheet or something like that. It's the sum over the years. All right, so having a little trouble with the mic this morning. Testing 1, 2. All right, so here's the balance sheet, right? And if you recall, the total assets, which is on the left, has to equal the total liabilities and the stockholders' equity, right? You always know that, right? That on the very bottom, the numbers have to equal up. All right, so the balance sheet, you'll notice the short-term stuff goes up on top, the cash, right, the inventory, and the current assets are all included in the short-term stuff. Accounts receivable, the infamous accounts receivable, money that you're owed, people didn't pay you yet. And on the bottom of is the fixed, long-term assets, the buildings, the cars. All right, so here's the short-term stuff. So, you could go over that, right? Cash, receivables, as I said, inventory. And on the current liabilities, the short-term liabilities, we have the, accounts payable, money that you owe, the bills, right? The wages you have to pay, any short-term loans you have. And here's your long-term debt, right? Kind of like long-term assets, you have long-term debt, and you may have some leases out. All right, so here's the income statement, right? Revenues is always on top, right? And as I said, you subtract off you end up with the gross profit, right? You subtract off the cost of goods sold in there somewhere, right? And you end up with gross earnings or gross profits, right? So you do that. All right, so here's your net income. All right, the third one, of course, is the statement of cash flows, and there's 3 components, right? 3 components of cash flow. And basically, the important term here is net cash burn. I'm going to take a sip of my coffee. And net cash burn is basically when the cash flow coming in is negative, right? You're losing money, obviously, right? So that's net cash burn. Let me just save this real quick here. All right. So you never really want a net cash burn, right? Obviously in anything, and so. All right. So a real important concept here is break even. As I said, you do a break even analysis, and you're trying to find out, when do I start making a profit after I cover all my expenses, right? And you've got variable expenses here, and you've got fixed expenses. So we've got that, right? So we've got all this stuff, and so let me once again save that. I don't know. I don't have the little thing up here about. All right. So we saved that. Sounds good. I'm happy. All right. So the break-even point, right? Break-even is right. Cash flow break-even. Here, I'll underline it here in a crooked line, and I'll draw a circle around here. Right. That's when you just cover your expenses, and they call that EBITDA, earnings before depreciation, amortization, and taxes, are zero, right? So you just cover that kind of stuff. All right, so I highlighted these in red already. So this is the basic equation we got to worry about. Right? EBITDA is revenues minus variable costs, R minus VC minus your cash fixed costs, right? Real simple math. And they abbreviate that CFC, right? So when you break even, when this is zero, the revenues have to equal the variable, right? The costs, the variable and the cash fixed costs, right? So you got to cover that. All right, so they break this equation down in many ways, and they eventually call it survival revenue, right? Survival revenue. You got to remember that if you take the variable costs and then divide it by the revenue, see right there, you're going to call that variable cost retention ratio. So the only thing you really have to concern yourself with, and here, let me is this guy right here, right? Oh, look at that, I'm a mess. All right, that guy right there. All right, so the survival revenue is the cash fixed cost divided by 1 minus the variable cost retention ratio. All right, so they break it down in a couple ways. It's only real one equation that they fool around with here. Can I move this? No, I gotta get out of this, man. All right, so let me just make sure I don't jump too far. All right, so we have this equation right here. All right, so here's an example, and we went over this in class. This is the example I showed you of solving that, and you have all these numbers here from your, this is a simplified income statement, right? Revenues, here's your cost of goods sold, right? Here's your expenses, and so it's good to look at these numbers and go over this example. It'll help you out, if you do that. Try to get a little closer here. All right, so if you plug these numbers in, you end up with a survival revenues of $1,143,000, and that should be your break-even point, right? That should be your exact break-even point. And if you solve that and make these your survival revenues, it's clear here where I highlighted in red that you just broke even, right? That's all. All you had to do was, break even right there. So the next dollar you earn, you're starting to make a profit, right? And they show that here. Here's the revenue, here's your costs, and there's your break even right there. All right, and then they show it again at a 60% revenue level, right? So, so right here, right, that point where they're pointing to right there is the, for 60%. And, it looks like your variable costs are low, so you need less money to break even, right? That should make sense to everybody. All right, so they're showing you for 65% and 60%. And you can clearly see, with less variable costs, you need less to break even, right? As they say right here, the VCRR declines, right? And so does your survival revenue to break even. All right, so that is basically about it here. That's the most important thing, right? Is that survival rate. Just go over that problem, and all right. So that's about it. And I will see you tonight. And if you have any questions, bug me. Alrighty, take care, everybody. Be safe today.